Hi pension subscribers and welcome back to the channel. Are you happy to pay the UK government 40% on all your estate and assets above your inheritance tax threshold? The answer to most clients to that, the answer is a resounding no. Nobody wants to spend their entire life working very hard to then pay the UK government 40% of that time, effort, and whatever you've created in terms of assets and money. This is unfortunately what happens to so many people though if you don't do the correct financial planning. In the UK, as you will know, you have £325,000, which is your inheritance tax threshold, before you start paying the 40% tax. Now, £325,000 is obviously a large amount of money. With your spouse as well, that becomes £650,000. However, anybody who lives in a property in England will know if you're living, say, anywhere near London or anywhere in that area, properties can easily go up to £1 or £2 million over the course of your lifetime by the time you've paid off your mortgage. And you can get really caught out here. Now, to caveat, if you're passing on your main residence, etc., it goes up to around £1 million per couple in terms of your allowance of inheritance tax. But still, a lot of people have assets of more than 1 million. But you have to think, how are your assets going to grow over the course of the rest of your lifetime? Are you going to exceed your lifetime allowance threshold? Possibly you're going to get divorced. Who knows what's going to happen in terms of your allowance? What we do know is you need to take care to start avoiding inheritance tax. Now, for a lot of my clients who are living abroad, the other big thing they say is, well, Dominic, I live in Dubai, or I live in America. I haven't lived in the UK for 10 years, so not my problem. I say, have you read about domicility? Where you were born, where your father was born? Do you understand how UK inheritance tax works? And it's attached to your domicility, not your tax residency. So for example, on the 6th of April next tax year, you could move to Dubai. You would then effectively be a Dubai tax resident at that point in time. You could stay there for 10 years and be a Dubai tax resident and a non-UK tax resident. Your domicility in UK inheritance tax would unlikely change. If you were born in Dubai and your father was born in Dubai, you lived in the UK for 10 years, then you went to Dubai for another 10 years, then possibly, yeah, you would be then, you wouldn't have any UK inheritance tax, but it all comes down to domicility. So this is really important to get in touch and talk with a qualified pension transfer person to understand how your assets, such as your pension schemes, etc., plug into your inheritance tax. If you want to have a conversation, get in touch below with myself to speak to myself or one of our senior financial advisors for a free initial consultation. Now, a very important point when it comes to pensions is UK pension wrappers are not included in your estate for inheritance tax purposes. This is excellent. It means money inside your DB, your DC, your SIP, or even a QROPS if you have one, will not form part of your estate for inheritance tax purposes. So, as I'm always saying to my clients during retirement, don't touch your pensions. If you're over your lifetime allowance, or sorry, if you're over your inheritance tax and you think you might pay a bill to the UK government, don't touch your UK pension. Leave it there. You can pass that on to your beneficiaries without them having to pay inheritance tax as long as it's done correctly. Other assets such as your liquid bank accounts, your property, any assets you have outside of a UK pension wrapper will attract UK inheritance tax. So during retirement, you're actually better to use all your surplus income platforms, any investment vehicles, and then use your UK pension assets last. Now, a lot of clients will say, well, what can I do about inheritance tax? Well, the older you get, the more difficult it becomes. I was dealing with a client in the UK last week. He's in his 70s and he's saying, Dominic, I'm going to be gifting £100,000 to each of my sons to avoid inheritance tax. I say, yep, it's better to do something rather than nothing, but there is a 7-year rule in place from the UK government, which means if you die within 7 years of gifting something to someone, you will have a tiered inheritance tax ban on that amount of money. So it's a bit risky to be giving away assets later in life. As with any type of planning when it comes to taxation, you have to start early. I'm 34 years old and I can almost say with certainty I will not pay a penny in inheritance tax. I think everyone pays enough tax as it is in terms of the societies we live in. Every single thing we do, every single time I employ an employee, everything that happens inside my company, everything I do when I'm walking down the street, buying things, shopping, whatever I do, all the services I use has VAT applied to it. We pay a lot of taxes to our government and I don't intend to unnecessarily pay them a large amount of my estate when I pass away. It's very easy at a young age, such as mine, to think, oh, it'll never happen to me, I'm really young, I've got loads of time to sort this stuff out. But why not start early? Now, most of you watching this are probably in your 50s and your 60s. As as such, you might not have as many opportunities as me, but you still have a huge amount of time to do correct planning to ensure that you don't pay or pay more inheritance tax than you need to. Now, there's some pretty complicated solutions that you can go into as well. We can set up discretionary trust funds, special purpose vehicles. If you've got properties in the UK, normally you would need to sell those or effectively move them into a limited company, which would then trigger capital gains tax. So it's an understanding of, should I pay the capital gains tax on the property to then get it into a trust or a limited company in order to not have it inside my estate for inheritance tax purposes. It's a conversation that we will go through with you with our qualified tax advisor. But there's many other things that you can do, small things that you can do to be reducing your inheritance tax liability. I would say this is the biggest killer for clients, and it's probably the number one thing which clients are not doing enough of. The very other simple solution, if your estate is pretty big, say you got 5 million in property, assets and whatever, and you say, it's almost impossible to give this money away. Or, you know what? I don't want to give it to my kids yet. I think they're reckless, or I think they're too young, or they're not mature enough. I would rather keep my 5 million, die with 5 million, and I realize that effectively on 4 million pounds, I'm going to have a 40% tax bill. So 1.6 million I'm going to have to pay the UK government when my family goes through probate. So what you can do is just take out a life insurance policy for 1.6 million. Then it means that when you pass away, your family get to keep all of the 5 million, and the life insurance of 1.6 million pays out to cover the inheritance tax bill that they would have to pay to HMRC. This is obviously very helpful because it means your family won't have to sell the assets down. Say they want to keep the family home that you've had for 100 years or whatever it might be. They haven't got to dispose of those assets in order to pay the bills to the government. But as you can see, all of this, whilst it's not nice to think about death, we have to admit all of us are going to die. You have to have a plan in place for dying. It's as important to have a plan in place for dying as it is for living. So get in touch now. We can discuss inheritance tax and see how we can help you reduce your liabilities. And as always, take care with yourself and your UK pension assets.